This is a quick start guide for the Excel Skills Business Valuation template. This template enables business owners and buyers or sellers of businesses to compile an informal valuation based on discounted cash flow. Let's have a look at the assumptions sheet. So, the first step in doing a business valuation based on the discounted cash flow methodology is to compile a cash flow forecast for this business, and we're using a 5-year period. So, on the assumption sheet, that is where we're starting. So, you need to enter estimated annual turnover with an annual increase percentage and a gross profit percentage for each year. So if it's a service-based business, you can just enter 100%. Then next, we have the operating expenses. So we have a list, and you need to enter the year one expenses. So if you need to customize this, you can just change the descriptions here. And you can insert rows above this row and add expense items to this section. If you add expense items, you also need to add them on the cash flow sheet. So you'll see the turnover, cost of sales, and gross profit calculations, and then your expenses section. So you manually need to add rows to the cash flow sheet as well. There's also annual increase inflation for expenses, which is used to calculate the year 2 to 5 expenses. Then we have working capital movements for inventory, debtors, and creditors. That also forms part of the cash flow calculations, which we'll get to. So you just enter the values, and it's a movement that you need to enter. Then there's CapEx, so cash outflow from capital expenditure is also taken into account. We'll cover that on the cash flow sheet. And then your last section is probably the most important, is your acquisition price and financing. So it may be weird that we're asking for a business acquisition price if the purpose of the template is to do a valuation. But what we need to calculate is the weighted average cost of capital. And in order to do so, we need to know how much debt and how much equity you're going to use in financing a business acquisition. So the acquisition price initially, you can put in anything that is a ballpark estimate of what the business is deemed to be worth. And then in terms of a business acquisition, you'll also enter a loan amount. So that is just to determine how much debt and how much equity will be used to finance the business acquisition. You also enter the cost of debt. So that's the interest rate percentage of a loan if you had to borrow money, and the repayment period in years. The last input cell is for the required return on equity before taxation, and that's subjective. So one investor may be happy with 20% before tax, another would require 30%, another only require 10%. So what you can also do is to work on the cost of debt initially, and do your valuation based on a full loan of the acquisition price. Your weighted average cost of capital would then be your cost of debt. Okay, so let's go to the cash flow sheet. So we've already just had a look at the turnover, cost of sales, and gross profit, and then your expenses section. And that gets you to a net profit before interest and tax for each year. We then take into account your working capital movements, and that if you adjust your net profit before interest and tax by the working capital, you get to a cash flow from operations. We also provide for capital expenditure to be included in the annual cash flow calculation, because with the increase in turnover and that growth in turnover, you may need to spend on your infrastructure in order to achieve those turnover growth goals. That basically then gets you to the annual cash flow total, which is used in the business valuation calculations. Just a note on the cash flow sheet, all the calculations on the cash flow sheet are automated, and the sheet does not require any user input aside from the if you add expenses to the template. So if you add an expense, you'll insert the required number of additional rows that you inserted on the assumption sheet, and you'll copy the formulas from one of the existing rows. Okay. So we'll then go to the valuation sheet. All the calculations on this sheet are also automated, and no user input is required on this sheet. The first part is the weighted average cost of capital calculation. As you can see, we use that acquisition price of $1,800,000 loan, so 200,000 equity, and this is our equity percentage. That's our cost of debt, so that gets us to a weighted average cost of capital of 12%. Our annual cash flow, so we'll, in terms of the business acquisition, you'll spend $1 million to produce these cash flows over 5 years. And then our estimated business valuation, we measure it based on the net present value. So a positive net present value means that it's a good investment. If it's negative, it doesn't achieve a return to get to a zero net present value, then that would be a very negative sign. The internal rate of return will give you your annual percentage. So those are, in this example, good rates. And then we calculate the estimated business valuation. So we're saying based on the equity and debt ratio that's included in the weighted average cost of capital, after 3 years, this business is estimated to be valued around 1.3 million, and in 5 years' time, 1.8 million. So this template is basically designed for small and medium enterprises. So that's why we work over a short investment period of 3 and 5 years. So that gives you an indication of what the business valuation should be. You can then play around with how that will influence your financing of the debt or equity, and the price in terms of the acquisition price that we entered. So we can go and change that and see how it influences our calculations. We also, at the bottom, just include a net cash flow after debt repayment. So that's just to give you an indication that if you have a loan of 800,000, how much cash flow you would have left after servicing the loan. Okay, so I'm just going to do an example here where we're going to say, based on this, I can see the value is around between 1.3 and 1.8. So I'm just going to work on 1.8. I'm going to go back here and I'm going to change this to 1.8 million. And I'm increasing the loan, let's say 1.5 million. So let's just go back here. So your WACC is just a bit down at 11.7%. So you can see your valuation in 5 years is still around 1.8. What you should take into account is that we're using the WACC as the discount rate. So if your WACC changes, then some of these numbers will just change slightly. But the range of the valuation is still the same. So it's between 1.3 and 1.8 million. And that's basically it. So our business valuation template is a relatively simple template that can be used to calculate the estimated value for a business. You can also look at our detailed instruction sheet where we cover all aspects of the template in detail. And you can also go to our support section of our YouTube channel where we upload videos based on user feedback.